If you're one looking for an investment with the potential of strong growth, great diversification, while minimizing the tax drag on your portfolio over time, the Schwab U.S. Large Cap Growth ETF SCHG is one of the best options I believe is available in the market. And in this video, I'm going to cover exactly what SCHG is, compare it to its top alternatives, and explain why you may also want to consider SCHG. Knowing that, my name is Sully, and all I ask before we get started is if you do find value in this content, that you consider hitting the like and subscribe button for future content like this. With that said, let's first go over what is SCHG. Now, to simply put it, SCHG is traded as an ETF, which means you can buy this fund on nearly any investing platform that you use. SCHG is also considered an index fund because it passively tracks a certain market index, where you can see the fund's goal is to track as closely as possible the total return of the Dow Jones U.S. Large Cap Growth Total Stock Market Index. All that means is that in the click of a button, you will gain access to some of the largest US stocks that exhibit growth style characteristics, where it states SCHG has a total of 229 holdings inside of the fund. Now, the Dow Jones has a ton of factors that contribute to what companies are eligible to be selected, where they state the classification of growth or value style companies are based on 6 measures: 2 projected, 2 current, and 2 historical. The measures include the PE ratio, projected earnings growth, dividend yield, and many other factors that go into the calculation for what's included in the index. Something else important to understand is that a fund like this is considered market cap weighted, which means the companies that are in the fund are given weight based on their size. For example, the top holdings in SCHG consist of many companies that you've heard of, where the top ones are Microsoft, Nvidia, and Apple, that contain the largest weight toward the fund, being roughly 30% among just those 3. Largely due to the structure, SCHG is composed of its largest sector being infotech at 45%, and is why a growth fund like this typically contains more risk, but offers the potential for higher reward. All in all, whether you're just starting off or an experienced investor, investing into SCHG allows you to easily gain exposure to many of the top growing companies in the market while reducing the risk of trying to pick the right stocks. Yet alone, it also reduces significant tax drag, which is crucial when you're investing in taxable accounts, but more on that later. Now, before I explain why SCHG is among my favorites, let's now go over SCHG versus its competitors. Now, because there's so many strong growth ETFs that you may want to consider, I'm going to narrow it down to my 2 favorite alternatives that even have more assets under their management, such as QQQ, alternatively QQQM, and VUG. To start it off, let's first go over Invesco's QQQ ETF that tracks the NASDAQ 100, which means you are able to gain access to the performance of the top 100 largest non-financial companies listed on the NASDAQ. The fund currently has 101 holdings, but even though that's significantly less than SCHG, the top companies have slightly less exposure, where Microsoft, Nvidia, and Apple are all around 8% of the weight. But due to the reduced holdings and solely being ones that are traded on the NASDAQ, there is more exposure to the technology sector, being roughly 57% of the entire fund. And if we compare QQQ to the S&P 500 ETF VOO, there's a 49% overlap, and with SCHG, that is 62%. So unless you want to try out numerous growth funds to test them out on your own, understand that because many have significant overlap, you may simply want to just pick one and stick with it. But one con to QQQ is that it is the most expensive of the 3, coming in at a 0.2% of an expense ratio, which means that every $10,000 that you have invested, every year you are paying $20 in fees. It's not terrible at all, especially for what you get, but an alternative here to choose if you are a long-term investor is their cheaper alternative, that is QQQM, that is a 0.15% expense ratio. But do know that I'm going to be using the historical data for QQQ to compare the options, but do know that QQQM is just the cheaper alternative that tracks the exact same index. And if you're in a taxable account, looking at the dividend distributions, the yields are super low for all these growth funds, but this one specifically has a 0.56% dividend yield over the trailing 12 months, which that is the highest of the 3 that I'm discussing in this video, but when compared to many other index funds, that is a very low dividend yield and very strong as far as tax efficiency long term. Now, aside from that, we've recently had a very strong market because QQQ over the past 10 years has averaged a 17.69% annual return. The past 5 years was 18.17%, and even the past year was 15.95%. Fun fact is that QQQ has beaten the S&P 500 7 out of the past 10 years, while generating a total of 410% of growth when compared to the S&P 500 at 235%. All very strong numbers, and is why you truly can't go wrong with any of the options I'm about to show. And so speaking of, the next alternative is the Vanguard's Growth ETF, VUG, that tracks the CRSP U.S. Large Cap Growth Index that contains 166 holdings, where the largest sector is also technology at 57%, and then the largest holdings are also Apple, Microsoft, and Nvidia, making up around 30% of the entire fund. Now, VUG is even closer to the S&P 500 as it has a 57% overlap by weight and even 85% overlap with SCHG, making them all very similar overall. On top of that, VUG has a 0.04% expense ratio, which is really cheap, and over the past 12 months, it has averaged a 0.46% dividend yield. And although the past doesn't guarantee the future, VUG over the past 10 years has averaged lower returns, being at 15.35%, the past 5 years was 17.19%, and the past year was 18.46%. But knowing that about QQQ and the alternative QQQM and then VUG, here's a breakdown on SCHG and why it is a strong growth fund to consider. Now, as I mentioned, SCHG has 229 holdings, where the top ones consist of Microsoft, Nvidia, and Apple, around 10%. But the thing about SCHG is that of the three, it has the lowest concentrated exposure to technology, being roughly 45%, where the others were 57%. SCHG is also in the middle with a 54% overlap with the S&P 500, an expense ratio of 0.04%, similar to VUG. And something else I also like, even though the difference is super small, is that SCHG has the lowest dividend yield of 0.4% over the past 12 months. The reason I even mention all this about dividend yields is because if you are investing in a normal brokerage account that is taxed, the dividends are going to trigger capital gains that you have to pay the taxes on, no matter if you reinvest them or not. By no means am I saying that this growth fund is better than the other because of that reason. The differences are super small, but if you were to compare a growth fund with a dividend fund, the difference there is significant, and if you are investing for the long term in a taxable account and want to build your portfolio over time, the difference could easily add up and allow you to miss out on a ton of opportunity. For example, let's say that you have $100,000 invested and have 100% of that in SCHG, where you trigger 0.4% of that in dividends every year, or a dividend fund like SCHD that may trigger 3.9% in dividends every year. That means either $400 or $3,900 would be added to your taxes every year, whether you reinvested the dividends or not. Now, I'm not saying anything bad about SCHD because I actually believe it's one of the best dividend ETFs to consider, and the dividends are known to be fully qualified if you hold them long enough, which means they can be taxed at long-term capital gains, which is even better. But depending on your situation, if you are a long-term investor in a taxable account, you can reduce the tax burden while having the opportunity for even stronger growth using growth ETFs. The choice of dividend investing is completely personal, but I more so see that as something to do down the road, or to slowly build into it over time, or more so to use a Roth IRA at retirement, because no matter what, dividends you receive then can be completely tax-free. But as far as the tax drag, growth funds like SCHG and the others I mentioned are considered very tax-efficient investments, and over time, the difference if you choose the wrong investments can significantly impact your portfolio. If you don't believe me, on a $500,000 portfolio averaging 7.5% per year, a tax drag between 0, 1, and 2% can easily end up costing you hundreds of thousands of dollars in future gains. So not just do taxes add up by the end of the year, but compounding your investments over time has even more of a cost that you may not even realize right now. And since learning that, I've really focused on any long-term investments in my taxable accounts to be as tax efficient as possible. But as far as the performance from SCHG, over the past 10 years, the fund has averaged 15.88% per year. Over the past 5, that has been 18.23%, and the past year alone has been 17.22%. All in all, when we look at the data over the past 10 years, it truly makes the decision on which one even harder, because QQQ has averaged the highest annual returns, where SCHG is in the middle and has even had better returns recently. And then if we look at the best single year performance, QQQ has grown 55% in 1 year, where SCHG was 50%. The volatility is highest for QQQ and the lowest for SCHG, and the Sharpe ratio, which measures the amount of returns per unit of risk, also shows QQQ over SCHG, but of all the worst years, SCHG's downside was the best, but not by much. Now, in a recent video, I actually went into great detail on VUG versus QQQM versus SCHG, and at the time, QQQM was actually my favorite. End of the day, all three are very strong options, which makes the choice really hard to decide on, but this is how I view each and would recommend based on your interest. So when choosing QQQ, if you like that it has the least amount of holdings at 101, the least overlap with the S&P 500, with the greatest track record long term, and don't necessarily care that it has the highest expense of 0.15%, and recently has underperformed both VUG and SCHG. Where when choosing VUG, if you like the holdings being in the middle at 166, the highest overlap with the S&P 500, it's achieved the lowest performance long-term of the three, but is very competitive over recent years, all while having a very low expense, then VUG may very well interest you. And then when choosing SCHG, that is if you like that it has the lowest exposure to technology, with the most holdings at 229, while containing very competitive returns, especially recently, with a very low cost. End of the day, there's a lot of factors that go into it, but it is a personal choice. I now currently like SCHG the most because it's lower on the tech, has the most holdings of the three, while still achieving some of the best returns, and it's really cheap. Now, because there are so many ways that you could view this, feel free to input your take on this in the comment section below for others and I to see. All in all, any of the three options that I mentioned are very strong options, and the most important thing going forward is to choose what you'll like the most and stick with it. I'll also mention that I've created an entire index fund cheat sheet covering the differences between these index funds and many of the other top options in the market, which I'll have linked in the description below if you want to check them out. On top of that, if you want to start investing on a new platform or check out other top financial products, I'll have direct links in the description below for you, which depending on the ones you choose, I may earn a commission for it, which is greatly appreciated. And if you want to see exactly how I allocate each of my investments and other exclusive content, consider checking out my Patreon linked below. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.